A creditor took the account inside your trust. The trust is valid. The notary was real. Nothing was signed wrong. You lost it at the signing table 3 years earlier. The pin was over 2 boxes. One said revocable, one said irrevocable. You checked the flexible one because you wanted to keep control. And the power you hold is a power somebody reaches through you. That box was the whole decision. Nobody at the table said so. Revocable felt obvious. You keep control. You change your mind whenever you want. You move the house back out if the plan shifts. Nothing gets surrendered. Nothing gets locked. Every instinct pointed at the box you checked. The instinct was right about what you keep. It was silent about what keeping costs. Control is a two-way door. If you undo it, somebody reaches it through you. Under the Uniform Trust Code, revocable trust property stays open to your creditors for as long as you're living. The spendthrift clause doesn't change it. The trust name on the deed doesn't change it. The estate tax reads it the same way. Section 2038 pulls those assets back into your gross estate because you kept the power to alter, amend, or revoke. Property you actually moved into a revocable trust does skip probate. It doesn't skip reach. And the window on changing course is already running, so you flip the other way. In the version of this people reach for, everything goes irrevocable, and the terms hand control to somebody else. The house, the brokerage account, the rental with the mortgage still on it. 2 years on, your daughter needs the down payment and the rental is the piece you meant to sell. The trustee is somebody else now. The answer isn't no. The answer is a process, and it runs on their calendar. You tried to solve the reach problem by handing away the thing your family needed on a Tuesday. The position doesn't get set once for everything you own. It gets set per asset by 4 questions. Which asset? Whose reach? Which timeline? What access? The house you'll live in for 30 years answers differently from the account you touch every month. And that split doesn't happen inside one document. It takes separate trusts, or one trust drafted to break into parts. Now the correction people need most. People say irrevocable trust automatically lose the basis reset. Not true. The label alone doesn't decide it. What matters is whether the asset is treated as passing from you at death, often because it's included in your estate. Revenue Ruling 2023-2 confirms grantor trust status by itself isn't enough. The law reads what you kept, not what you named it. The power to revoke isn't a feature of the paperwork. It's held by a person, and the person doesn't last. When you die, the power dies with you. The trust locks. Set it up with somebody else and your portion locks while theirs keeps running, depending on how the document was written. California treats this as a real event, not a technicality. The trustee owes the beneficiaries and heirs a notice within 60 days of it. So the flexible box you checked on a Tuesday afternoon is the box your family inherits. They don't get to check the other one. Your convenience became their constraint the moment you stopped breathing. There's a second thing, and it isn't the same thing. In California, lose capacity and the trustee starts answering to the beneficiaries instead of to you. The power doesn't end there. Who the trustee serves does. 2 things people get backwards about irrevocable. Locked doesn't mean sealed. In California, whatever you kept the power to revoke is still on the table when you die. If the rest of the estate runs short, your creditors reach it. Your valid debts and estate expenses get paid before your beneficiaries receive what is left. And locked doesn't mean unchangeable. Some irrevocable trusts change by agreement. Others need a judge. And in some states, a trustee moves the assets into a new trust with better terms. Lawyers call it decanting. Irrevocable is a high wall. It was never a vault. Every one of these moves has a clock on it. For Medicaid long-term care, federal law generally looks back 60 months at covered transfers made for less than fair value. State rules can differ. California currently uses 30 months. Relinquish the power to revoke inside 3 years of death, and Section 2038 counts it anyway. The positions you set at 55 hold up. The ones you set at 84 get tested. Wait long enough, and your family inherits the position you never chose. Same table, same pen. This time, the house sits in one structure and the operating account sits in another because they answered the 4 questions differently. The paperwork got more involved. What you bought with it is knowing what you're keeping and who inherits the keeping. The law reads the power, not the title.
4 questions. Which asset? Whose reach? Which timeline? And what access? Run those questions against every major asset you own. The right answer for your house might be the wrong answer for the account you use every month. And remember, control and protection pull in opposite directions. The more control you keep, the more reach you may leave open. Write the answers down. Then take them to a qualified estate planning attorney before you move anything or change your trust. Set the position while you're still the one holding it. If this helped, like, comment, and subscribe. See you on the next one.